How does actuarial science value life insurance policies? Imagine trying to predict the future of a life insurance policy, knowing that many things can change over the years. That's what actuaries do. They use math and statistics to figure out what a policy is worth today based on what might happen in the future. When a financial advisor reviews your policy, they're relying on these calculations to see if everything still makes sense. Actuarial science estimates the value of a life insurance policy by looking at all the money the insurer expects to pay out in the future, like death benefits and dividends. It also considers the premiums the insurer will collect. Each of these future payments is adjusted by how likely it is to happen. For example, if the chance of a policyholder passing away in the next year is 1%, the value of that payment is weighted accordingly. These expected cash flows are then discounted back to the present using an interest rate. This process helps determine what those future payments are worth today. It's not just a simple calculation because it includes the chance of different outcomes, such as policy lapses or changes in expenses. This way, the valuation reflects real-world uncertainties that can happen over many years. There are two main types of valuation used in life insurance. The first is reserve valuation. This calculates how much money the insurer needs to hold now to pay future claims. These reserves are carefully regulated to make sure the company can meet its obligations. For example, in Canada, actuaries use a method called the Canadian Asset Liability Method, which allows them to adjust assumptions based on current economic conditions. In the United States, a formula-based approach is common but is gradually becoming more flexible. The second type is appraisal valuation. This looks at the overall value of the insurance company, including its assets, existing policies, and future business. It helps investors and company managers understand the financial strength of the insurer. When a financial advisor reviews your life insurance policy, they use these actuarial valuations to check if the insurer is financially healthy. They look at whether the reserves are enough and if the policy still makes sense for your long-term goals. If the valuation shows the insurer might struggle to pay future claims, the advisor might suggest adjustments or even a different policy. In short, actuarial science gives a clear picture of what a life insurance policy is worth by using detailed models that consider the chances of different events happening. This helps insurers stay prepared and helps you, as the policyholder, make smarter decisions about your coverage.